Hey, well, good afternoon, everyone, and welcome back to another session at PPA 555, Public Budgeting and Finance. After tonight's session, we only have two sessions left after this, so we are progressing along very quickly toward the end of our term together, as these hybrid courses do tend to go by very fast. Let me just first start by thanking you for your discussion board posts. I've gone through all those and have reviewed those and provided feedback. I think everyone did a very nice job of identifying the budget format in their cities. Uh, Granted, the vast majority are line item budgets. I think we saw not all, but nearly all were line item budgets. There were a couple of examples of a line item budget that had some performance elements incorporated into it. One example of a city that goes through a modified zero-based budgeting process, but for the most part, just what we expected to see, the vast majority of cities using line item budgeting. I also think everyone did a really nice job of talking about what budget format they thought might be superior to the current budget format. Most folks talked about performance budgeting and incorporating some performance indicators. Again, the more information you can incorporate into your budget document, the more useful that document can be for things like management and planning functions. If all you have is just a line item budget, the only information you have is how much money you spent last year and what you spent that money on. If that's all the information you have, then you're going to be able to make only very small incremental types of budgeting decisions from one year to the next. And so that's where we have seen some cities move toward the incorporation of some performance indicators. But budgeting is something that it's kind of difficult to break the status quo. And whenever cities are comfortable with how they're doing their budgets, they tend to just keep doing the budgets in that same type of manner year after year after year. So I think everyone did a really nice job on that. And I went and looked at the budget and compared the budget to the answer. And I think everyone was accurate in their assessment of budget format. So that part one of the post-instructional assignment, that question on budget format, I think everyone's in very good shape on. I think you already have that answer ready to go. When we were talking last week, we finished up our discussion last week looking at our different indicators of fiscal solvency to, again, help you with part one of the post-instructional assignment. And I introduced you to Brown's 10-point indicators, to Wang, 2, and Dennis and their indicators. And we talked about some of the differences and similarities between those indicators. And I said on the post-instructional assignment, what I'm hoping you will do is take maybe 2 or 3 of those indicators and utilize 2 or 3 of those indicators in order to assess the fiscal solvency of your city. So just going beyond just revenues versus expenditures and actually use a couple of those indicators. So your next beach board assignment number 3 that's coming due next week, for that assignment, you're going to deal with this issue of fiscal solvency again, but rather than looking at the budget of your city, you're going to look at their annual comprehensive financial report. And every city should have their annual financial report up on their website. A lot of cities call it a CAFR, Comprehensive Annual Financial Report. But in the nomenclature today, we're really moving away from CAFR and talking about them more as annual comprehensive financial report. So just kind of inverting the C and the A in the acronym. Your city should have that available for you on the website. So for the next beach board assignment, what you'll do is download a copy of that annual comprehensive financial report, review that financial report, and then use that financial report to answer the fiscal solvency question. How fiscally solvent do you think the city is? What information did you use to assess fiscal solvency? And which of those indicators we talked about last week did you use to assess fiscal solvency? And then if you did provide an answer on the pre-instructional to how fiscally solvent your city was by looking at the budget, did that answer change now that you're looking at the annual comprehensive financial report with knowledge of these different fiscal solvency indicators? So that's what you'll be doing for your beach board essay number 3 post that is due next week. As I told you last week, I did provide on our beach board site a link to a video. I don't know if you have a chance to take a look at it yet, but it's a link to a video of how to read an annual comprehensive financial report. We're going to talk about that as well tonight in the first half of class, and I'll kind of clue you in if you haven't read one before. of the major sections in the annual financial report and the type of information you can find in each one of those sections. We don't have the time or the wherewithal in this class to actually go through reading an annual comprehensive financial report, so I'll leave that to you. But I do want to introduce you to some of the major sections so you have an idea of where to find some of the information you need to calculate these fiscal solvency indicators. And then again, for the Beach Board essay, just a couple, 2 or 3 of those fiscal indicators in order to assess fiscal solvency upon your reading of the annual comprehensive financial report. That's kind of where we are right now in the class. So for tonight, what we're going to do is in the first half of class, we're going to talk about everyone's favorite topic, which is accounting. I know it's not the most exciting topic in the world, and I am no accounting expert. I am no CPA, but it is important for us to understand the role that accounting plays in public finance and how accounting is something that's actually integrated throughout all of the finance functions that you engage in when you do public finance in a government organization. So it's not just something that happens after the fiscal year is over. There are accounting mechanisms that are built into everything that we do with purchasing and all of our functions we do every single year. So we'll start out talking about accounting. Again, I'll then talk a little bit about annual comprehensive financial reports and the relevant sections you'll want to be looking at. Then we'll take a break, and then the second half of class, we will then shift gears and move into a discussion of capital budgeting and debt management. And that will be then for the second half of class. The next week, we'll be able to, hopefully, if we get all that done tonight, move into a discussion of revenue and taxation and get into a discussion of all the different types of taxation, the evaluative criteria that we use to assess different forms of taxation, and do all that next week. And then if we get through all that next week, then the final week, we can then talk about intergovernmental fiscal relations and kind of put a bow on everything and wrap up everything that we've talked about during this term. So that's a really quick overview of where we are and where we are going over the next couple of weeks. So if there are no questions or anything, without further ado, let's go ahead and jump into governmental accounting. And as we talk about accounting, we're going to talk about how accounting works, and we're also going to really focus on some of those differences that we see in terms of governmental accounting versus how accounting may work in our private lives or in the private or nonprofit sector, because governmental accounting is really different. If you are interested in accounting, especially governmental accounting, there is a course in the program, PPA 567, Government Accounting and Financial Reporting, I believe it's called. I think it's either government accounting or basic accounting. It's 567. The course isn't offered very frequently because there's sometimes some staffing issues, because we like to bring in someone who has city management type of experience, but also is a CPA as well. And combining those two things is kind of difficult in one person. So it's not a course that's offered every semester, but hopefully it'll be offered again in the very near future. If you're interested in accounting, you can really explore more in-depth accounting issues if you take that 567 course. What we're going to do tonight, though, is we're just going to kind of hit the tip of the iceberg with governmental accounting, familiarize yourself with some of the procedures that are used in governmental accounting. We'll talk about fund-based accounting and accrual-based accounting, talk about the different types of funds where we segregate money, why we segregate money into different funds, and then also talk about the differences between accrual-based accounting and cash-based accounting. So governmental accounting is really under the auspices of this organization known as GASB, the Government Accounting Standards Board. And the Government Accounting Standards Board is the organization that is responsible for promulgating the guidelines that cities need to follow in doing their accounting and preparing their annual comprehensive financial reports. What the Government Accounting Standards Board will do is every now and then it will issue what it calls a statement. And that statement will then give guidance to cities on different aspects of accounting principles. And so, give you an example, there was a very famous statement number 34, that came out of GASB several years ago. And statement 34 requires that any type of enterprise, so if you're running some type of a public enterprise that generates a profit, that those public enterprises need to use accrual-based as opposed to cash-based accounting. That's a requirement that was in statement number 34 that came out of GASB, that now cities all need to adhere to that requirement. A more recent requirement that came out of GASB is something called statement number 75. And in statement 75, GASB tells local governments that, again, for their enterprise funds, for their public enterprises, they have to include the value of the capital plant, the actual physical buildings. That value has to be included in the assets that are reported by those public enterprises. It's meant to try and give a broader picture of the finances of these public enterprises. What that has done, though, is that has kind of complicated things, because now when members of the public look at the assets and the liabilities of a public enterprise, they see massive assets and very few liabilities, because the assets are being artificially inflated with the value of the buildings that those public enterprises occupy. Obviously, they're not true liquid assets, because you're not going to sell the building in order to get a hold of that cash. If you do, you'll have no place to do business. But it's just one of those requirements from GASB that requires of city governments. So GASB is a very important governing body when it comes to government accounting. And GASB requires that local governments adhere to GAAP, which stands for the Generally Accepted Accounting Principles. So GAAP, the Generally Accepted Accounting Principles. And two of the fundamental accounting principles that you need to adhere to as a local government are fund-based accounting and accrual-based accounting. So in our discussion here in the first half of class, we're going to focus most of our attention on those two basic principles, fund-based accounting and accrual-based accounting. So let's start with that first principle of the first GAAP principle of fund-based accounting. Fund-based accounting essentially means that governments need to segregate their money into different funds, or different pots, if you will. So you don't commingle money together all in one fund. You have to separate the money into different funds or different pots of money, depending upon either where the money is coming from, how the money is being generated, or what that money is intended for, how that money is going to be spent. So you can see on the screen there, we have three broad categories of funds. There are governmental funds, there are proprietary funds, and there are fiduciary funds. So all the different pots of money fit into essentially one of those three different fund categories. So to start with, in governmental funds. In governmental funds, we have different specific types of funds within that broad category. So one example of a governmental fund is the general fund. The general fund is the fund where you spend most of your money for the daily operations of the government. That's going to come out of your general fund. For most governments, they call their general fund Fund 01. So it's the first fund, it's the general fund. This is where salaries and benefits and all those types of things are going to be paid out of the general fund. Now, the general fund, oftentimes the largest portion of the general fund will be what we call unrestricted money, in that it's money that the government has the ability to spend without a whole lot of limitations and a whole lot of strings attached. So some money in the general fund is unrestricted. And in fact, the majority of the money in the general fund is probably going to be unrestricted money, where you have a lot of flexibility and latitude in how you spend the money. But there's also some money in the general fund that will be considered to be restricted money, restricted funds. Restricted funds are limited in how they are to be spent. So to give you an example, from my experience on the school board, every year we would approve our budget, and we would have our general fund, our Fund 01, and probably about 70% or so of that general fund money was unrestricted. Most of that money came from the base grant. Most of that money came from the state of California in that base grant spending that you can then spend on your pupils kind of however you see fit. It's unrestricted. But about 30% of our general fund was from restricted sources. So for instance, sometimes you would have money coming in from the federal government for Title I through Title IV spending. Title 1, 2, 3, and 4. Titles 1, 2, 3, and 4, that federal money is restricted money in that it must be spent on certain types of things. So Title 1 money can only be spent on what we consider to be program improvement schools. And so schools where you have a large enough percentage of students that are considered to be at-risk students. Either they are at risk from a socioeconomic status type of perspective, or they're English language learners, or they are students with disabilities. They are considered your at-risk students. And if a school has enough percentage of those at-risk students, then it becomes a Title I school. And then that Title I money must be spent at that school to benefit those students and cannot be spread across the entire district because that money is restricted. But the general fund money, that's where most of the money that you use to do your daily operations, that's where that money is typically found, in the general fund. You may have some money that's coming in from special dedicated revenue sources. So you may have a certain form of taxation that is generating revenue. If that revenue is coming from a special source of revenue, then it usually goes into this second type of fund known as a special revenue fund. Because we want to make sure that because this money is coming from a dedicated revenue source, that it's not commingled with our more general revenue sources in the general fund. So, one example of a special revenue fund is you may, say for instance, you have a neighborhood and you want to put in streetlights in that neighborhood. Well, that the people who are going to benefit the most directly from those streetlights are going to be the people who live in that neighborhood. So you think what we want to do is we don't want to spread the cost across the entire city for people who will never use the streetlights in that neighborhood. We really want to concentrate the burden of paying on those people who are using those streetlights on a daily basis, who live in that neighborhood. So you create an assessment district in that neighborhood. And that assessment district will then charge an extra amount of property taxes. And then you capture that extra property tax revenue that's being paid by those citizens who live there in that area. And then you use that to pay for the streetlights. You'll probably issue debt and then repay the debt with those property tax revenues. That's money coming from a special source, then going for a specific type of expenditure. So clearly you want to wall that money off from all of your other general revenue. So we segregate it into a special revenue fund. Third type of a governmental fund is what's called a debt service fund. And debt service funds are sometimes referred to as sinking funds. So it's just the word like to sink, the sinking funds. Some governments call them sinking funds, some call them debt service funds. But the money in the sinking or debt service fund will be used to obviously service debt. So you borrow money, you then have to make principal and interest payments on that money. Those principal and interest payments will come out of the debt service or the sinking fund. Again, you want to make sure you've got that money so that you can retire the debt and you do not default on the debt. You default on the debt, it's going to have some very serious negative implications for your city's credit rating. Another example of a governmental fund is what's called a capital projects fund. A capital projects fund is a fund where you put the money that you're going to be using then to construct these capital projects, a new recreation center or a new city hall. Again, you need to have that money segregated from all the rest of your money so that you have enough money to finish those capital projects. And each one of these different funds will have different numbers attached to them. And so, in my district, general fund was Fund 01. The special revenue fund, I believe, was Fund 17. The debt service fund, I believe, was Fund 56. The capital projects fund, I think, was Fund 47. And so they all have their own numbers to delineate them from the other types of funds. But the whole purpose of fund-based accounting is, again, to segregate the money so we have more control, so we're not double spending money. You would hate to have money set aside for the recreation center, and then you commingle it with your general fund, and you end up spending that money for salaries. That's going to be a problem because you then don't have enough money to finish that city hall or that recreation center. So those are examples of what we call your governmental funds. And that's where most of the money is going to be. It's going to be in one of those types of governmental funds. Then a second category of funds, what we call proprietary funds. Typically, proprietary funds will be for money that's coming from the operation of some type of a business or some type of an enterprise. So the two different types of proprietary funds are enterprise funds and internal service funds. Enterprise funds are for, again, public enterprises. And so again, from my experience, we had a child development program in my district. They charged tuition. They generate their own revenue. That revenue then went into an enterprise fund. The money, I think it was Fund 63, but that money in that enterprise fund was then walled off from all the rest of the revenue because that money was to be used for the maintenance and operation of the enterprise that generated that money. And that's the important distinction here with enterprise types of funds. The money in an enterprise fund is earmarked for the maintenance and the operation and sometimes development of the enterprise that generated that revenue. Now, what governments can do is if governments run short on revenue, they can borrow money from the enterprise fund, but they have to repay that money in a timely manner. So in my district, we had a bylaw whereby you could only borrow up to $1 million from the enterprise fund, and that money had to be repaid within 6 months. So it's not really the government's money, it's money that belongs to the enterprise. Third category of funds are what are called fiduciary funds. And the money in a fiduciary fund is money that does not necessarily belong directly to the government. So one example of that would be a trust fund. So you might have something like, again, the Highway Trust Fund. And the Highway Trust Fund, that money is legally obligated to go to the construction and reconstruction of bridges and highways and roads. That money is not something that government has control over to then take and spend someplace else. A pension fund is another example of a fiduciary fund. In a pension fund, these are monies that belong to our future retirees. So the money doesn't belong to the government, it belongs to our future retirees. Government is just managing that money until those folks retire and are eligible to then receive their benefits. So again, it's not necessarily the government's money. Interagency funds. That's an example is if, for instance, if you have a federal grant that is targeted to go toward a local government, but that grant has what we call a state pass-through requirement. In a state pass-through requirement, the money must first go to the state. The state then holds the money for a period of time before allocating it to the local government. That money doesn't belong to the state. That money belongs to the local government, but it passes through the state. And as it passes through the state for that 3 or 6 or 9 month period of time, it goes into that interagency fund because it's not the state's money. And so the state has to ensure that it's protecting that money and it's not spending that money on its own projects. But again, the whole idea with fund-based accounting is that we are segregating the money into different funds, either based upon where the money comes from or where the money is going. So we have more control over the money, so we are not double spending money and spending money on one thing that needs to be spent on another thing. So all governments engage in this type of fund-based accounting. The funds that they use are pretty much very similar to what you see on the screen. Few modifications here and there, but for the most part, those are the general types of funds that most local governments use. So that's fund-based accounting, controlling the money by segregating the money into different funds. The second primary principle under GAAP is the idea of accrual-based accounting. And this is a major difference between the private and the public sector. In your private life, you usually use a type of accounting known as cash-based accounting. And so in our private lives, we count revenues as revenues when we receive them. So revenue could be your paycheck that comes in on the first of the month. Once that money on the first of the month goes into your account, you consider that to be revenue, because you've realized that it's actually in your account. You're now able to go out there and spend it. Under a cash-based system, you consider expenses to be expenses when the money is actually spent. So when you go to the grocery store and you spend your $150 on groceries. When you actually spend that money at the register, that's when that money is considered to be an expense, because that's when it is leaving your account. So essentially, revenues are revenues when they come into your account. Expenses are expenses whenever the money leaves your account. You write the check or you use your debit card. That's when it's considered to be an expense. And that's a cash-based system. That's a type of system that we typically use in our own private lives. Governments don't use that type of system typically. Governments tend to use a system known as accrual-based accounting. And the way in which accrual-based accounting has developed over the years is that there are actually two main types of accrual-based accounting. There's modified accrual and there's full accrual accounting. Modified accrual accounting is used for the vast majority of governmental money. So this is what governments use most of the time, is over 90% of the time, is modified accrual accounting. For their enterprise funds, and because of the Gatsby statement we talked about earlier, they have to, for their enterprise funds, use a full accrual method of accounting. But that's only for enterprise funds. Everything else is done through a modified accrual process. Nonprofit organizations, large nonprofit organizations, oftentimes use full accrual accounting. Small nonprofit organizations typically use cash-based accounting. But modified accrual accounting is something that's relatively unique to government organizations. So let's talk about some of the differences between modified and full accrual accounting. Under modified accrual accounting, revenues are posted in the period where they are measurable and available and collectible. Well, what does that mean? That means that if you have tax revenue coming into your government, you can consider that revenue as revenue even if you haven't collected those dollars yet. So say, for instance, you've got your state fiscal year that runs from July 1st to June 30th. You anticipate having tax revenue, property tax revenue, that's coming in, we'll say on July 15th. Well, since it's coming in on July 15th, you would normally think that that revenue is going to be counted against the next fiscal year that began on July 1st. But under modified accrual accounting, you can count it against the current fiscal year that hasn't ended yet. So even though it's not coming in until July 15th, you can take that revenue and count it as revenue against your current fiscal year that's ending on June 30th. So even though your current fiscal year is ending before you're actually going to collect this money, you can still consider it as revenue because it is measurable and it is collectible. It's property tax revenue. We know with very good accuracy exactly how much money we're going to generate from the property tax. We know what our property base is. We know what our collection rates are. And so it's pretty easy for us to have a very accurate assessment of how much revenue we will be collecting from the property tax. So it's very measurable in nature. It's also very collectible because property taxes tend to be collected at a rate above 97%. So it's not unusual for a city to collect 99% or over 99% of the property tax levy that's owed to that city. So that's considered measurable and collectible. Under a modified accrual process, you could consider that revenue that's coming on July 15th as revenue during your current fiscal year, and you can apply it to your current fiscal year. So there's more flexibility in when you consider revenue as revenue. If you were doing a cash-based system of accounting, you would have to wait till July 15th to consider that revenue as revenue. Under modified accrual, you don't have to wait until July 15th. And also under modified accrual, expenditures are posted whenever the liability is incurred. So whenever you have incurred your liability, and a liability is a claim against your assets. So governments have their assets, some more liquid than others, but they have the assets and things that they own. And then a liability is a claim against those assets. Someone has a contractual claim against some of the assets owned by the government. So you purchase something from a private vendor. That private vendor then sends it to you along with a bill. When you have received those goods into inventory and you have the bill, that's a contractual liability. That private vendor has now satisfied their part of the deal. They have provided you with those goods that you have purchased. So now that they have done their part, you have to do your part. So that bill is then a liability. And at that point in time, under modified accrual, you can consider it to be an expenditure. Now, you haven't actually written the check yet. You haven't actually paid the money yet, but it's a legal liability against your assets, and so it can be considered to be an expenditure. So you can see you have a little bit of flexibility under modified accrual and when you consider something to be revenue, when you consider something to be an expenditure. More flexibility than what you'll normally have under a simple cash-based system of accounting. And again, what modified accrual does and why it's beneficial for governments is that additional flexibility helps them balance their books better because they don't have to wait for the revenue to come in. They know exactly how much they're going to get, so they can go ahead and use it to balance their books because they know it is coming in. Now, if you're a company, the amount of revenue that's coming in is going to be based upon the amount of sales that you make. And sales can fluctuate. Sales, you can have some very big changes in terms of demand, what we call elasticity. There can be a lot of elasticity for the demand for certain types of goods. So you're not 100% sure you're going to get this sales revenue that you think you're going to get. With property tax revenue, you're pretty darn sure. If you're not 100%, you're probably more than 99% sure about how much revenue you're going to get. So it gives you that type of flexibility. Then there's what's called full accrual accounting. In full accrual accounting, you have even more flexibility in terms of when you consider things to be revenue. So revenues posted whenever it is earned and expenses posted whenever the good or the service is being consumed. So what does that mean? That means under full accrual accounting, you don't have to necessarily wait for those revenues to be measurable and collectible. You can go beyond, just the example we use in modified accrual is the money's coming in on July 15th. The fiscal year ends on June 30th, so we can, 2 weeks, we can then count that toward the previous fiscal year. Under full accrual, you can go even beyond those 2 weeks. You can go months into the future and consider something to be revenue when it's being charged, essentially. And so whenever you're charging someone or some type of entity for this revenue, it's considered to be revenue, even though it's not as collectible as it would need to be under a modified accrual type of system. Your expenses under a full accrual system, you consider something to be an expense whenever you consume that good or service. Whenever that resource, that good or service is used up, that's when it's considered to be an expense. So let me show you an example that should hopefully clarify some of these differences between a cash-based system, a modified accrual system, and a full accrual system of accounting. So let's assume that we have a city that's going to hold a fireworks show. It orders its fireworks, and the show is scheduled for July 4th. Since it's a fireworks show, they're having it on the 4th of July. No surprise there. The fiscal year runs from July 1st to June 30th. So it's your typical fiscal year like we have here in the state of California. So the city orders its fireworks on May 21st. The fireworks arrive in city inventory with a bill with an invoice to be paid on June 15th. The fireworks show occurs on July 4th, so you shoot off the firework during your show on July 4th. The city then actually cuts a check and physically pays for the fireworks on July 10th. So how do we consider this to be an expense or expenditure based upon the three different accounting systems? Under a cash-based accounting system, it's considered to be a disbursement, an expense on July 10th when you write that check. So when the city actually writes the check or transfers the money to the fireworks vendor, that's when it's considered to be an expense, July 10th, under a cash-based system of accounting. Under a modified accrual system of accounting, it's considered to be an expenditure when it becomes an accounts payable. Whenever these fireworks have arrived in inventory along with the bill, the vendor has sent you the fireworks, they have upheld their end of the bargain, you now have a legal liability, you have a legal requirement to then pay for these fireworks. And that occurs on June 15th. So under modified accrual, it's considered an expenditure on June 15th when you receive the fireworks and you receive the bill. Under a full accrual system of accounting, it's considered to be an expense whenever the fireworks are consumed. Well, the fireworks are consumed during the fireworks show on July 4th. Well, so what? The big so what here is under a cash-based system or a full accrual system of accounting, the expense would be considered an expense in the new fiscal year, in the next fiscal year, because these things are happening after July 1st. The fireworks are being consumed on July 4th. That's in the new fiscal year. That would be under a full accrual system of accounting. Under a cash-based system of accounting, it's not considered an expense until the check is written. That's occurring on July 10th, again in the new fiscal year. However, under a modified accrual system of accounting, the expenditure would be counted against the previous fiscal year because you received the fireworks, you received the bill on June 15th. That's in the last fiscal year. So these distinctions do make a difference. Cash and full accrual accounting would be an expense against the next fiscal year. Modified accrual would be an expenditure against the current fiscal year. And I'm saying expense and expenditure for a reason. Under cash and full accrual accounting, we consider when we spend money as an expense. It's called an expense. Under modified accrual, when we spend money, it's considered to be an expenditure. And so you see people talking about an expenditure because they're dealing with modified accrual accounting. When they talk about it as an expense, it means they're dealing with either a cash-based system or a full accrual system of accounting. So I hope that example kind of clarifies some of the differences between cash, modified, and full accrual. Most of us work in governmental agencies, and so most of us deal primarily with modified accrual accounting. And modified accrual accounting is going to be used for the vast majority of our expenditures, with the exception of expenditures that occur by our public enterprises. So any money that is in that enterprise fund from that public enterprise, that money is then accounted for with a full accrual system accounting. Everything else in the city government is going to be done primarily with modified accrual accounting. So those two principles are important. Fund-based accounting, we have to maintain different funds and segregate our money into different funds to control how that money is being spent, what that money is being spent on. And then we also have to abide primarily by modified accrual accounting as government agencies. Another important principle that we follow under the generally accepted accounting principles is this idea of double entry accounting. And that's a pretty simple concept, but it's something that every government, and really this is true in the private sector as well, that every entity is supposed to follow. That's what's called double entry accounting. Double entry accounting means that every single expense or expenditure must be recorded twice. So you have backup essentially. So every expenditure must be recorded in what we call a journal. The journal is a chronological listing of all the transactions that the government has engaged in. So all these transactions, all these expenditures are listed in chronological order in the journal. And then each one of those expenditures, each one of those transactions also must be listed in a separate place, which is called the ledger. And in your ledger, you are grouping your transactions according to account or category. So they get grouped according to category in the ledger. They get listed chronologically in the journal. And again, this is double entry accounting, so that everything is entered twice. So you can then reference your ledger entries with your journal entries. And if there's a discrepancy, then there's a problem, because everything that's in the ledger should then also be in the journal and vice versa. That double entry accounting is again being done for control. Nearly everything that we do in accounting, we are doing for the purpose of controlling. So we try to control all the money that is being spent. So those are your, and you usually link up the numbers in the journal with the ledger so that you can, you don't have to comb through it, but you can link it up by the number of transactions. So this transaction has the number in the journal and has the same number over in the ledger, so you can link up those same transactions with each other. Another device that we use for control in accounting is the use of documentation. in the form of financial reports. So some organizations will produce quarterly financial reports. The vast majority of organizations will produce annual financial reports. Again, they used to be called CAFRs, now they're called ACFRs. And there were some cultural issues in terms of CAFR, kind of as when you actually pronounce it in some languages, is a pretty unsavory type of term to say. And that was brought to the attention of GASB. And so a couple of years ago, GASB recommended to governments that they change it from a CAFR to an ACFR, annual comprehensive financial report. Not a lot of cities have caught up to that yet, but you'll see in the near future, more and more will have annual comprehensive financial reports. I provided on our Beachboard site the example of the City of Long Beach comprehensive financial report. So you can go through that and get accustomed to reading a financial report. Annual financial reports are the retrospective document for a government. So as we had said before, the budget is prospective. This is how we plan on spending money in our next fiscal year. The comprehensive financial report is retrospective. It shows you how you actually spent the money in the preceding fiscal year. I think the one I have up there is maybe 2019. But it shows you how the money has been spent. If you combine the budget with the annual financial report, those two documents combined together will give you the most holistic picture of the fiscal solvency of your city. And if you want to know everything about the finances of your city, you look at the budget, the prospective document, and the annual financial report, which is the retrospective document. Some of the important parts of an annual financial report. Most annual financial reports will have an introductory section. That introductory section will introduce you to the city. It will introduce you to the city council members, to the city manager, to oftentimes the city treasurer or whoever's doing the finances for the city. We'll kind of give you that introduction to the city so you can learn a little bit more about the city and who the main players are from a fiscal perspective in the city. That second section you see up there, what's called a management discussion and analysis, otherwise known as an MDA. This is a very important part of the annual financial report because this is the part of the report where the city tells its residents in very easy to understand terms and narration, this is the current fiscal picture for the city. GASB started requiring this management discussion and analysis section several years ago when GASB realized that annual financial reports were not terribly user-friendly. And if you've already looked through the example I have up on our Beachboard site, or you've already pulled the annual financial report for your city, and you've gone through it, you probably realize that it's hundreds of pages long. There are a lot of tables, there are a lot of numbers, and they're not the most intuitive things to read in the world. So by having this management discussion analysis section, the city can say in very explicit terms and in very clear terms, I should say, what the finances look like for that city so that every citizen can understand the city's finances without combing through all the dozens and hundreds of tables throughout the entire annual financial report. So the management discussion analysis is a really useful section that you should certainly start with before you get into the actual tables and the actual financial information. Once you have reviewed the management discussion analysis, you kind of have this overall picture of the finance of the city in terms of what's been going on with their revenue, what's been going on with their expenditures, and what's been going on in their corporate property tax base. The city will talk about all that within their management discussion analysis. You can then move into the third section, which is the financial section. This is where you get all your hardcore numbers. This is where you get all your tables for the actual numbers in terms of assets versus liabilities, the numbers in terms of revenues and expenditures for each one of your individual funds that the city has. This is where you get the nuts and bolts of all of the dollar values and all the tables in the financial section. Financial sections also include a lot of notes. And so what cities will do is rather than notating things within a table, they will just kind of put a little footnote next to it And then later on in the financial section, they'll then have their notes. And the notes is when they will explain anything they feel needs to be explained in those tables within the financial section. But the actual numbers themselves will come from the financial section. So if you're really looking at, drilling down in terms of assets and liabilities for enterprise funds, you're going to get that in your financial section. If you're going to drill down in terms of the specific sources of revenue, in terms of specific sources of taxes, those numbers are going to be in the financial section. The fourth section is what's called the statistical section. And a lot of people, when they review annual financial reports, kind of gloss over the statistical section, but I would recommend that you actually pay some attention to it, because some of the indicators that we talked about last week involve things like per capita, taking revenue and taking expenditure, assets, liabilities, and making a ratio per capita, per individual in the city. That means you're going to have to know population, and you have to know population trends. Population trends you're going to need for calculating per capita. Those pieces of information are found in the statistical section. If you want to know what population trends over the past 10 years are, that will be in the statistical section. If you want to know what their trends are in terms of their indebtedness, the amount of debt that the city owes over the past 10 years, that will be in the statistical section. So in the statistical section, you'll see a lot of trend data to kind of show you the pattern of if things are getting better or things are getting worse. Corporate property tax base, number of employers in the city. You'll have trend data over the last 10 years in that statistical section as well. So essentially all four sections of the annual financial report are important, but you pull different pieces of information depending upon which section you are looking at. You want a brief introduction to the city, that's the introductory section. You want a very common sense, very easy to understand narrative about the city's finances, that's the management discussion and analysis section. You want to drill down into the actual numbers of assets and liabilities and revenues and expenditures for all your different types of funds, the balance sheets and the balancing sheets, those all come out of your financial section. You want trend data on population and corporate property tax base, any trend data, that's going to come out of the statistical section. So you take all those four sections together, and they'll give you a pretty good, broad, holistic view of the finances of your city. Now, what I'm asking you to do in the third beach board posting is to look through the comprehensive annual financial report, look through those four different sections, and then calculate 2 or 3 of the indicators of fiscal solvency we talked about last week in answering the question about how fiscally solvent the city is. And then, if you did that already for your budgeting, for your pre-instructional assignment with the budget, it's always nice to kind of compare. Because now you've got the indicators, now you've got the annual financial report, so you've got a lot more information that you can use in order to answer that fiscal solvency question. And again, it's a good way from an assessment perspective where you kind of see that growth in assessing fiscal solvency from the beginning of the class up to this point in the term. Again, I recommend that you look at the video that I have online. It will take you step by step through these different sections, and it's kind of an annotated video. So what it will do is it will show you the types of information that you can find in each one of those sections, and where you can find different pieces of information. And I recommend watch that video. Have the City of Long Beach annual financial report open as well at the same time, and then you can kind of cross-reference between the two. And they show you, here's the information you can get in this part of the financial section. They can go to that part of the financial section in the Long Beach annual financial report and actually kind of put that to practice. So again, we don't really have enough time tonight to go into walking you through an actual financial report, but the video, I think, does a pretty good job. And that, combined with having the Long Beach financial report, I think should really give you a really nice introduction to how to assess fiscal solvency of a city by using those types of financial reports. So that type of documentation, whether it be quarterly financial reports or annual comprehensive financial reports, that type of documentation is another element of control, another way that we can control how much money we're spending and what we are spending that money on. Another way that we can control it before we get into auditing, another way we can control it is we can control our expenditures through what we call administrative controls. And so an administrative control in accounting would be limiting the number and type of people who have spending authority. By limiting the number and type of people who have spending authority in your organization, you are exercising what we call an administrative control. So you don't want everyone in the organization to have the ability to spend money. If everyone in the organization has the ability to spend money, you're going to blow a hole in your budget. You're not going to be able to control how that money is being spent. And so you designate certain positions within your organization to have that ability to spend the money. And by limiting the number of people, number of positions in your organization that have the authority to spend money, you are inherently controlling the amount of money that you are spending and what that money is being spent on. So we don't just do control through documentation like financial reports, we also do it through administrative controls by limiting who has spending authority in our organizations. That's another important part of accounting. Oftentimes, what you will see is whenever at the end of the year an audit is done, and as a governmental organization, we have auditing requirements. We have to go back and audit the books. One common material finding in an audit is a lack of internal control. And that's something that happened in my district, where we got dinged a couple times in the audit for a lack of internal control, where there were too many people who had the ability to spend money. You know, they all had their little PIN cards that they could go out there and spend the district's money. And the auditors pointed out, you're losing control. You need to have fewer people who have that authority. That will then give you more internal control over how you're spending your money. But speaking of auditing is something that is required of government agencies. The type of audit and the frequency of the audit will depend upon the type of agency you are and what type of money you are spending. If you are spending your own revenue, own source revenue, then you're probably going to have fewer auditing requirements than if you are spending intergovernmental aid. So if the federal government is giving you federal money to spend, there are going to be more audit requirements because the federal government wants to make sure that you're spending the money in the way that the federal government wants you to spend it. You're spending the money to further those national objectives that the money is supposed to be spent on. So again, it depends upon the money you're spending, depends upon the type of organization you are, how often you do audits, and the types of audits that you do. Again, give you an example that in my district, we passed this big bond issue in 2014, $148 million bond issue. But in order to pass that bond issue, we had to have a citizen oversight committee set up. And so we have a citizen oversight committee that then reviews how that money is being spent on the construction of new schools and modernization projects. That citizen oversight committee has audit requirements. And that twice per year, they have to have an audit done to make sure that the money is being spent the way it's supposed to be spent, because it's money that is being spent that has come from the passage of a measure by voters. So voters need to get some reassurance that the money is being spent the way in which they were told that the money would be spent. Two basic categories of audits that we tend to see used are either financial or performance-based audits. Financial audits are oftentimes called legal audits. So sometimes you'll see them called financial audits, sometimes you'll see them called legal audits. In a financial or a legal audit, we are asking the question, how did we spend the money? Was the money spent in the legally mandated way that it was supposed to be spent? So again, if you've got federal money coming in, the federal government will require that you have a financial legal audit so that they can see that you are spending the money in the way in which they told you you must spend the money. If you're not spending the money the way in which you were told to spend the money within the parameters of the grant language, there's a good chance that you will then not be allowed to get that grant again next year. So financial legal audits, are we spending the money? How are we spending the money? Are we spending it in accordance with the way in which we are supposed to spend that money? Then the second type of audit is what's called a performance or management-based audit. In a performance or management-based audit, we're asking the question, how well did we spend the money? So not just did we spend it where we were supposed to spend it on what we were supposed to spend it on, but how well are we accomplishing our goals and objectives by how we are spending that money? So are we, accomplishing our strategic plan goals with spending this money? So it's really about how well. So you see both financial as well as performance-based audits being used. When you read an audit report, and I think I may have an audit report up on the website if you're so inclined, you can go and take a look at it. But when you read an audit, the thing that you are looking for in an audit report are issues of what are called materiality. And that actually is a word. Hope I spell it right in text chat. Materiality. These are material issues. These are issues that are important enough that they need to be cited within the audit report. There are things usually that need to be corrected. They are material issues. So some things are material issues. Other things are not important enough to be material in nature. So when you read through an audit report, there will be one section of the audit report that will be headed with something like material issues, or issues to be considered, or something like that. Those are your material issues that are important enough that the auditors have found it necessary to really single out those issues, because those issues could have an impact upon your ability to control the amount of money you're spending and what you're spending that money on. So an example of a material issue could be if the government is using money from another fund, putting into the general fund that doesn't belong in the general fund. So it's money that's earmarked for the streetlight project, and they're taking and putting in the general fund to spend it on something else. That's a major material issue, because that's a violation of fund-based accounting. That is certainly going to be a material issue in an audit report. Lack of internal control. Again, if you have people spending money who should not be spending money and should not have that spending authority, that's going to be a material issue as well. Those material issues in the audit report are important because they need to be rectified. If they are not rectified, it means that you could actually be operating outside of compliance with government code. So those are things that need to be addressed immediately. Non-material issues sometimes don't need to be. So, for instance, the auditor may say that the organization chart's a little confusing. We're not really clear on who this person is reporting to. That's something that can be clarified by the organization, but it doesn't rise to the material level. It's not an issue of materiality that would actually get you dinged on the audit report. It's just mentioned in passing, something to think about, but nothing that actually could put you out of compliance with auditing principles, with GAAP principles, or with governing code. So we have these audits done all the time. Again, usually we have at least an annual auditing requirement for some organizations and some type of spending. We have audits that are required twice per year, but every organization will have to engage in auditing to see how we're spending the money, and oftentimes to see how well we're spending money, and if these inputs are actually contributing to the achievement of our goals and our objectives. So that is a very, very quick overview of governmental accounting. We did it in about an hour, so we did it very, very quickly. Again, just kind of the tip of the iceberg. If you are interested in learning more about accounting, the 567 class would certainly do that for you over the course of the entire semester. If the government accounting class is not offered in a given semester that you can take, there are other accounting courses that are offered across campus as well. You just want to be forewarned that if you take an accounting course in the College of Business, it's not geared toward government agencies. I know some of the other departments within our college, such as Recreation and Leisure Studies, I believe that they used to have an accounting class as well. I think Healthcare Administration, I believe they used to have an accounting class too. So there are some other venues you can go to if you're interested in accounting. But hopefully the 567 class will come back in the very near future if you are interested in more information on governmental accounting. So now we went through all that very, very quickly, but again, it's important because accounting is something that is interwoven into all the functions of the organization. Sometimes we think about accounting in terms of auditing. We're like, well, we don't really worry about it until we're told we have to do an audit. And then if we're subject to an audit, then we start to worry about how we've accounted for all this spending. If you account for the spending along the way, you make sure you do double entry accounting, you make sure everything's entered in a journal and a ledger, you make sure you abide by the requirements of fund-based accounting. You do all these things with all your transactions throughout the entire fiscal year. Then when it comes time for an audit, you're not that worried because you've already done all this and incorporated all this into the everyday functions of your organization. So before we take a break, any general questions about auditing or any of these topics we've talked about over the past hour? Okay, well, let's go ahead and take a break then. Let's take a break. Come on back at, come on back at 5:10. So we'll take about a 10-minute break, come back at 5:10. We'll shift gears into capital budgeting. We'll talk about how we put together capital budgets and capital improvement plans, and then spend the rest of our time talking about how we finance these capital projects through the issuance of debt. So take a break, come on back at 5:10, and we'll get into capital budgeting and debt management. Okay, well, it's 5:10, so we are back from break. I know it was quick, but we do have a lot of information left to cover tonight on capital budgeting and debt management. So let's go ahead and jump right into it. Okay, make sure we are still recording. So up until this point this term, we have talked primarily about operating budgets. As you know, the governments typically have two different types of budgets. They have operating budgets and they have capital budgets. Operating budgets fund most of their day-to-day types of functions. Capital budgets are then reserved for those high price tag capital projects like city halls and rec centers and senior centers and fleets of police vehicles and all those good types of things. So what I'd like to do tonight is spend a little bit of time talking about the second type of budget, the capital budget, how it works, how we put together capital budgets, how we construct capital improvement plans, and then finally, how we fund a lot of these capital projects. So most state and local governments will maintain a separate capital budget in addition to their normal operating budget. And the purpose of a separate capital budget is to fund capital projects, and capital projects are those projects that usually have a very long lifespan. So if you're going to construct a recreation center, you hope that center will be around for many decades with proper maintenance. So it's going to be around for a long time. There are also capital projects that tend to have high price tags. And so depending upon the project that you are constructing, some projects may cost upwards of $100 million. When I first joined the school board, we were spending about $50 to $55 million on a new school building. Now new school buildings are close to about $80 to $90 million. And it's a lot of that cost escalation that has occurred over the past several years for a variety of different reasons. They're also non-recurring items. And so these capital projects are items that you're not going to be paying for each and every year. So you're going to build that building, and then once that building's done, the building's going to stay there, and it's not going to need to be paid for again, at least for quite a long period of time. So those are our capital types of projects that tend to be funded with these capital budgets. State and local governments maintain a separate capital budget, but the federal government typically does not. So the question is, well, why do state and local governments separate out their operating and their capital budgets? Well, one argument for having a separate capital budget is increased efficiency. The decision-making model that you're going to use for a capital project is probably going to be different than it will be for a recurring type of expenditure, such as the amount of supplies that you're going to use from one year to the next in your government agency. Maintaining a separate capital budget also allows you to stabilize your tax rates. What this means is that you want to be able to pay for these capital projects over a long period of time. If you had to raise taxes enough to pay for an $80 million city hall all in 1 year, that increase in the tax rate would be cost prohibitive for your residents. And so what you want to do is you want to be able to pay off that building over a long period of time so that the tax increase is going to be much smaller and much easier to handle for your citizens. Having a separate capital budget also allows you to plan for the permanency of results. that these are permanent types of projects. They're going to be around for generations to come. It gives you more rationality in how you are planning for which projects to fund and how you're going to construct those projects. Overall, it's just a much better management tool to have a separate capital budget at the state or the local level. Now, the federal government, as we said, does not maintain a separate capital budget. The federal government uses a unified budget where it puts everything together into one unified federal budget. So the question becomes, well, why does the federal government feel necessary to use a unified budget and not use separate capital budgets? Well, there are a variety of reasons. One reason is the federal government is much more likely to run a deficit. Now, the situation is if you're at a state or local government, you have a constitutional prohibition against running a deficit. My internet's getting a little unstable, so let me turn off my camera for a second. So there's a constitutional prohibition against running a deficit at the state or the local level. There is no such constitutional prohibition against a deficit at the national level. And one of the reasons why there's no prohibition against running a deficit at the national level is because of what we call counter-cyclical spending. And so the federal government wants to stimulate the economy by spending more money. So you would typically think that, we've talked about this before, in poor economic times, you would spend less money because there's less revenue coming into the federal government. But instead, in poor fiscal times, when less money is coming into the federal government, sometimes the federal government spends more money in order to get more money in the economy, stimulate the economy, so that you will then get additional revenue in the future. That's called counter-cyclical spending. Also, the scope of the federal government is so incredibly large that one capital project or even 100 capital projects are not going to adversely affect that federal budget. If you're a small city and your overall general fund budget is $50 million, and you have to build a new city hall that's going to cost you $50 million, that's going to blow a huge hole in your budget. So it gets segregated out into a separate capital budget so you don't have to worry about running a deficit and blowing a hole in your operating budget. The federal level, when you're talking about the trillions of dollars being spent by the federal government, a $50 million project doesn't make a bit of difference. It's a pebble in the ocean for the federal government. And the federal government doesn't have the same concern over credit ratings that state and local governments have. And we'll talk later on tonight about some of the factors that will contribute to the credit rating of your government, some of the things that credit rating agencies will look at in order to give you a credit rating. One of the main things they will look at is your balance of revenues and expenditures. Well, for state and local governments, they need to balance their revenues and expenditures, not just because they're told to do so by the Constitution, but also because they want to maintain a good credit rating. The federal government can run a large deficit year after year after year and not have to worry much about their credit rating, because the federal government will always be able to issue debt. People will always buy federal government debt, but they won't always buy state and local government debt. So the federal government's not that concerned about its credit ratings, and so it's not that big of a deal if it runs a deficit as compared to state and local governments. So state and local governments maintain a separate capital budget. The federal government typically does not. So how do state and local governments then put together and construct these capital budgets? Well, one of your primary steps in the capital budgeting process is the selection of capital projects. Which projects get included in your capital budget? And the primary tool that you use to determine which projects get included in your capital budget is this multi-year capital improvement plan, or a CIP. Your CIP, your capital improvement plan, will schedule out over the next 5 years which projects will be funded in your capital budget. Typically, those projects that are included in the capital improvement plan are based upon need. So we will prioritize all the different possible capital projects, and then the most necessary ones will be the ones that get included in the capital improvement plan. Then year one of your capital improvement plan then becomes your capital budget. We conduct an inventory analysis, so we take a look at the status of our current physical plant, our current capital plant, to see what types of things need to be renovated, what types of things need to be replaced, and we'll then schedule those projects over that 5-year period of time in our capital improvement plan. So we're going to do a project-by-project analysis in putting together our capital improvement plan, and we're also going to do a year-by-year analysis of revenues and expenditures to make sure we have enough money in order to fund these projects we want to put into year 1 of our capital improvement plan. So as we are doing this project-by-project analysis, as we are comparing our recreation center to our senior center to our new city hall, there are a lot of different factors we're going to analyze in determining which projects make it into our capital improvement plan and eventually into our capital budget and which do not. And so I've listed some of those different factors on the screen there for you. The first one is capital and operation costs. So capital costs is essentially construction costs. So how much will this facility cost to actually construct? But then you also have to think about how much will it cost to operate on an annual basis, because constructing it is one thing. Keeping it open is a completely different consideration. So you have to think about both capital, construction, as well as operating costs. Health and safety concerns. So what are some of the impacts that this project will have on the health and safety of citizens? So if you're comparing a recreation center to a senior center, that recreation center ostensibly will have some pretty profound health and safety benefits for your citizens. A healthier population means more productivity, less missed work days, less money being spent on healthcare. So there are a lot of really nice benefits that will accrue with that recreation center. But there could be some health and safety concerns as well. Will people get hurt using that recreation center? And if so, what's that mean for the liability of the government? Do we have to have certain types of insurance covenants that will protect us from those types of health and safety concerns? How about the effect on the economy? We're going to construct a new recreation center that's down the street from a 24-hour fitness or an LA Fitness. What type of impact will it have on the business of those private sector companies by building this new publicly owned and operated recreation center? What are some of the environmental and social effects? Typically, whenever you engage in the construction of a capital project as a government here in the state of California, you will be subject to what's called CEQA requirements. And there's a piece of legislation here in California called CEQA, and it's the California Environmental Quality Assurance Act, CEQA. CEQA will require that you do a study to make sure that your capital project is not having an adverse impact upon the environment in that area where the capital project is being constructed. Now, typically, if you are just replacing square footage, so you already have a building, that building is just going to be torn down and you're going to put a new building on that same footprint, and it's the same amount of square footage, you can get a waiver to those CEQA requirements. You don't have to do that extensive CEQA report. But if you are constructing a brand new building or adding square footage, you're probably going to have to put together a CEQA report. And that CEQA report can be very, very expensive. In my district, sometimes we spent upwards of $200,000 on consultants to put together our CEQA reports. Disruption and inconvenience. As you are constructing this facility, obviously you are going to inconvenience some people. You're going to disrupt traffic patterns. How much disruption is there? What's the duration of that disruption? How much support is needed for these capital projects? So you think about infrastructure support. So will you have to run your sewer system, and you have to put extensions of your sewer system to try and provide those types of infrastructure supports to that recreation center? Do you have to run electrical lines or whatever you need to do in terms of utilities? So how much infrastructure support is necessary? What's the amount of risk? What's the risk that this project won't get done or will not come in on time and that you'll run over budget? What's the risk that some of the benefits we think will accrue because of this recreation center actually do not occur? So how much risk is involved with this project? And then what are the consequences of not finishing the project? This is something a lot of governments have had to deal with over the past 2 or 3 years. because of cost escalation. Again, that's come from a variety of factors. Tariffs and trade wars have contributed to it. Supply chain issues have contributed to it. High rates of inflation have contributed to it. So we have a lot of this cost escalation that when a government approved a project back 2 or 3 years ago, they may have approved that project to cost $40 million. And today, that project, now they're getting around to building it, may cost $80 million. Well, what do? Do you just not do the project? If you've already started the project, do you leave it unfinished? Or do you have to scale that project back so that you are not doing the entire project that you were planning on doing because you don't have the $80 million that it would cost to construct that project today? So a lot of factors that we need to take into consideration as we are comparing our different possible projects for inclusion in our capital improvement plan. One of the best tools that we have, it's not a perfect tool, but one of the best tools that we have to do this type of analysis to compare project versus project is a cost-benefit analysis, like we mentioned last week in our discussion of analytical tools in budgeting. Now, last week, we just kind of glossed over cost-benefit analysis. So we said in a cost-benefit analysis, we are going to try and identify the benefits and the costs of a project. We're then going to try and monetize those benefits and those costs, how much of those benefits and costs in dollar values. We're then going to discount those dollar values from future value to present value, and then we'll calculate our benefit cost ratio of our net present value of our benefits divided by our net present value of our costs. Sounds like a very simple type of process, but it's very difficult to do a cost-benefit analysis because there are a lot of externalities and a lot of additional considerations that we have to keep in mind in doing a cost-benefit analysis. And so let me digress for a second and kind of give you an example of some of the problems that are inherent in conducting a cost-benefit analysis. And the example I like to use comes from two policy authors called Weimer and Vining. And I don't know if you've taken the policy course yet. I don't know what text instructors are currently using, but back in the day when I taught policy analysis, I oftentimes like to use the Weimer and Vining text. And Weimer and Vining give us a good example of some of the problems associated with cost-benefit analysis. In their example, they say, let's consider the example of a government that wants to increase the tax on alcoholic beverages. So this is something that they're considering doing. So they're going to put together a cost-benefit analysis to try and monetize the costs and the benefits of increasing a tax on alcoholic beverages. So if you're going to increase the tax on alcoholic beverages, you need to know what that's going to mean for demand and consumption. Because ostensibly, if you are increasing the tax on alcoholic beverages, that's going to have a price effect in that as the tax goes up, the price of those alcoholic beverages will go up as well. So as the price of alcoholic beverages go up, will that depress consumption? Will that mean less demand for those more expensive alcoholic beverages? But in order to know what impact it's going to have upon demand, you have to know what type of alcoholic beverage you are talking about. Are you talking about beer, or wine, or hard liquor? Because there are different elasticities of demand for beer, wine, and liquor. So you have to break it down by the type of alcoholic beverage. But then you also have to break it down according to who's consuming that alcoholic beverage, because those different types of beverages will have different elasticities for different groups of people. And again, when we say elasticity, we're talking about how much demand will change if the price of that alcoholic beverage goes up. The more demand changes with an increase in price, the more elasticity the demand for that alcoholic beverage has. The less demand changes with an increase in price, the less elasticity. And we'll say that's very demand inelastic. So if you're looking at younger individuals, there's a much greater price elasticity, demand elasticity for things such as hard liquor with younger individuals than with beer. So younger individuals, regardless of the price of beer, are more likely to continue buying beer than continue buying hard liquor. However, for older individuals, the price elasticity for beer is much greater than their price elasticity for hard liquor or for wine. So not only do you have to know what type of alcoholic beverage, you have to know who your consumers are, as your different consumer categories will have different demand elasticities. Then you also have to try and figure out the benefits that will accrue from an increase in the taxation of alcoholic beverages. Now, obviously, it's going to increase the price, so hopefully it will bring in more revenue, unless it's a very demand elastic type of good. It's going to bring in a little bit more revenue. So that's going to be one benefit. But there's also the possibility that if it is very elastic in nature, the higher you raise the price, the less consumption there will be. So if people are consuming less alcohol, then there'll be less instances of drunk driving. Well, that's a benefit, but how do we monetize that benefit? Well, we have to think about who's involved in that drunk driving accident and what's the effect of that drunk driving accident. So the person who is leaving the bar and is driving drunk, that person is fully informed of what they're doing. They know they've been drinking and getting behind the wheel. So they're fully informed of that risk. The person they run into, the innocent person who's just driving along on the same road, they're probably 0% informed that the person coming toward them has been drinking. So you have different information asymmetries between the person who's been drinking and the person who's not been drinking. Well, if you reduce the number of drunk driving incidents, you could have fewer incidents in which there's property damage. And so you can calculate the amount of property damage, less property damage you get because of fewer drunk driving accidents. There could be fewer insurance claims. There could be fewer hospitalizations. So you have to try and monetize that. And hopefully fewer fatalities because of fewer drunk driving accidents. But then you have to monetize fatalities, and you have to monetize the value of a human life. And just to kind of illustrate their point, Weimer and Vining say, the value of a human life, we went out there and we did a literature review. And we looked at literally hundreds of different articles to see what the value of a human life is. And those articles range from a low value of $60,000 per human life to an upper range of $8 million per human life. So because of that big range, we're going to establish the value of a human life for our study at $1 million. Well, that's very subjective. Think about what happens if they would have said 5 million, or if they would have said 70,000. So again, there's a whole lot of subjectivity that's built into a cost-benefit analysis and a lot of moving parts in doing a cost-benefit analysis. The cost-benefit analysis is a useful tool for comparing projects for inclusion in a capital improvement plan, but a cost-benefit analysis is never the solitary tool to use. It's never the only tool to use. It is a complementary tool, but never solely sufficient in and of itself. And there was a very good article several years ago by an author by the last name of Williams. And Williams wrote an article entitled Cost-Benefit Analysis, Bastard Science or Insidious Poison in the Body Politique. One of the greatest titles of any public budgeting article I think ever written, at least in the past 30 or 40 years. And the premise of the article was that, just what I said, cost-benefit analysis is a useful technique, but unfortunately, governments sometimes use it as their sole technique. And when used as their sole technique, we have to recognize there's still a lot of subjectivity that's built into the identification of benefits and costs, as well as the monetization of those benefits and those costs. In budgeting, we typically use cost-benefit analysis. In the policy world, you typically use more something like cost-effectiveness analysis. Cost-effectiveness analysis looks at how well you're achieving your goal. Cost-benefit analysis looks at the costs and the benefits and tries to monetize those costs and those benefits of a certain type of course of action. So it's a really nice supplemental tool to use cost-benefit analysis, but it's never the sole tool that we use in choosing between capital projects. But when we do choose a capital project, we decide that we are going to fund a capital project in our capital budget. We know that we are probably not going to use our own governmental employees in order to construct this project. We are going to contract out to a private sector contractor and have that private sector contractor then use their expertise to construct the facility. So this is kind of your provision versus production type of dichotomy we talked about in our very first class together. Provision is providing the resources to make production possible. The production's actually doing it. So the provision will be from government. And so government will pay for this contract and will fund this contract. And then the private sector contractor will actually do the production, the actual construction of the facility, which means we have to do what we call put projects out to bid. And I don't know if you've been involved in a competitive bidding process before, but here in California, there are requirements in terms of which governments and which types of projects need to be put out for competitive bidding and which can be done through a negotiated bidding process. In a negotiated bidding process, you pick a contractor and you negotiate a price with that contractor. In a competitive bidding process, you put out a request for proposals and you invite all these different contractors to submit sealed bids to you as the government. You will then establish a date at which in a public venue where you will open up these sealed bids, and then you award the contract to the lowest responsive and responsible bid and bidder. That's competitive bidding. The idea about selecting the lowest bid is obviously to save money for the public, save public taxpayer money, but the bid that you accept must be both responsive and it must come from what we call a responsible bidder. And again, all these stipulations for how we contract out these types of projects are all found here in California in Public Contract Code. That's Public Contract Code 2100 through 2929. In case you're playing along at home, if you ever want to read it, that's where Public Contract Code is found here in Government Code in the state of California. So you solicit all these bids to come in. You then open up all these sealed bids, and then you award the contract to the lowest responsive bid from the responsible bidder. So what do we mean by responsive bids and responsible bidders? A responsive bid is a bid that responds to all the elements of the request for proposal, for the RFP. So the bid that you accept must address all of the requirements in the request for proposal. If it doesn't address all the requirements of the request for proposal, it's considered to be a non-responsive bid, and it's then eliminated from consideration. So even though we are accepting the lowest bid to save taxpayers money, that bid must be responsive to the requirements of the project of the request for proposal. Then the individual, the organization, the contractor that is turning in that bid must be fiscally responsible, which means that they must have the fiscal wherewithal to actually carry out the construction of this project. They must be registered with the Department of Industrial Relations here in California, otherwise known as the DIR. So they have to have their DIR number. They must be insured. They must be bonded. That's considered a fiscally responsible bidder. If the bidder does not have a DIR number, if the bidder does not have bonding and insurance, then they're considered to not be fiscally responsible, and that bid can then be eliminated. So it must be a responsive bid, and it must come from a fiscally responsible bidder. Sometimes what we'll see happen is that the government will then select the lowest bid, and they will then award that contract. You'll have another contractor that will then protest that awarding of the bid. So another contractor will say, I'm going to protest this because the lowest bid either was non-responsive or it came from a not fiscally responsive bidder. And so they'll protest it. They can go to the city council, protest it with the city council, and then it's up to the city council to determine whether or not to uphold that bid protest. So it's a process to go through with competitive bidding. Here in California, though, there are a few shortcuts that the state gives to local governments to try and make the competitive bidding process a little bit more expedited, if you will. One is what's called the piggybacking process. So in piggybacking, what a local government can do is it can find a contract that has already, a request for proposal, I should say, that's already been written by another government for a similar project, and it can then piggyback its request for proposal on that request for proposal. Basically use it as a template and just change the name of the government and the price and all those types of things. But just basically use that proposal that was already developed as a template for your proposal. Again, just kind of to fast track it and give you a little shortcut in putting together these RFPs. Another shortcut that the state of California allows is what's called contractor pre-qualification. And under CUPCA, the California Uniform Public Construction Cost Accounting Act, governments are able to pre-qualify contractors. And so they have them fill out an application. They basically vet them to make sure that they are fiscally responsible. And then once they are vetted and pre-qualified, they go into a pool of contractors. So that whenever you have a project come up, instead of going out and putting out these proposals out to everyone in the entire society, you can go to your pre-qualified contractors and you can award projects to those pre-qualified contractors. So essentially you're getting the whole vetting process done early on and out of the way so that you have an entire pool of vetted contractors you can then use for your capital improvement projects. Again, there are a lot of details and a lot of nuances in how contracting must work here in the state of California. But for the most part, if it's above a certain amount of money, you have to go through this type of a competitive bidding process because, again, this competitive bidding process is spending public taxpayer money on these contracts with private sector contractors. You can do an entire course on contracting here and public contract code here in the state of California. And actually, when I was chair, I found someone who actually would teach a course on procurement and contracting. And unfortunately, he put the course on the schedule and it didn't fill until the course had to be canceled. So we're hoping to get that course into the normal rotation of the program in the near future if possible, because a lot of the money that we spend as a government, we spend through this contracting process. And it's not our employees who are doing the work. We're actually contracting with the private sector contractors. And so contracting and procurement is a huge part of what we do in the public sector. But again, we have limited time tonight. So just to wrap up capital budgeting, we know why state and local governments maintain a separate capital budget. And we know they do that so that they can, have a better decision-making process. It's a better management tool. It allows them to not blow holes in their operating budget. We know all the good reasons for capital budgeting. But we also have to recognize there are some drawbacks with capital budgeting as well. The capital budgeting process means that we're going to need to continuously revise and reappraise our capital improvement plans. They are 5-year plans, but when they are constructed, they are not carved in stone. Things are going to happen. Crises are going to occur. You may have a major catastrophe in your storm sewer system. And so you have to repair that storm sewer system. It may not have been in your capital improvement plan, but because of the failure of the system, it now is in your capital improvement plan. So you have to reappraise, revise, and move some projects around in that CIP. So it requires constant reappraisal and revisiting. The decision of what to include in your capital improvement plan and eventually in your capital budget sometimes can be subject to politics. And we know there are some instances where the federal government, if it has a vested interest in that government funding a certain type of capital project, it will come along with, for instance, a matching grant. And we'll tell the local government, if you will fund the recreation center, we will match the amount of money you're spending dollar for dollar. But that then lowers the cost of that recreation center and makes the benefit cost ratio for that recreation center look a whole lot better than the senior center. So the local government will probably fund the recreation center. So sometimes external actors can get involved in order to kind of nudge cities in one direction or another in terms of the projects that they are funding. Some people say that having a separate capital budget eliminates the pain of spending money. And by eliminating the pain of spending money, it means that there is now money available that would not have been available if you would have put this project in your operating budget. The decisions would be much more difficult if you had to decide between funding the recreation center and paying salaries or providing this social service program. That's a more difficult decision to make than to say, well, let's just put the recreation center funding over in the capital budget so it won't affect any of these important programs in the operating budget. And it really does start to skew our decision making toward borrowing money. It makes it easier for us to borrow money than if we had to make those difficult decisions by putting those capital projects within our normal operating budget. But be that as it may, as we said, state and local governments do maintain this separate capital budget for their capital projects, and it's kind of a different animal than what we encounter in putting together and managing our everyday budgets in our operating budgets. So it's important to note that we do have that separate capital budgeting process that is going on. But these capital projects and these contracts to construct these capital projects are typically paid for through the issuance of debt. So we're going to borrow money in order to construct the recreation center or the senior center or the city hall. So the question then becomes, how do we issue debt and what types of debt do we issue in order to fund these capital projects? Well, typically to fund a long-term capital project, we're probably going to issue long-term debt. And by long-term debt, we're talking about debt that matures in more than 1 year. So debt that we're going to pay off over multiple years rather than just paying it off in one calendar year. So if we're paying it off over multiple years, we consider that to be long-term debt. The primary type of long-term debt that we fund that we borrow at the state and local level is called a bond. So long-term debt is usually called a bond. Short-term debt that matures in less than a year, is usually referred to as a note. So here we're talking bonds, long-term debt maturity of more than a year. Sometimes the maturity on those bonds, the long-term debt, can be upwards of 20, 30, maybe even 40 years that we're going to take to repay that debt. So what types of bonds do local governments tend to use to fund their long-term capital projects? The traditional type of bond is what's called a GO, or general obligation bond. And general obligation bonds are the type of debt that used to be most common. This is what governments used to use to fund their capital projects, general obligation bonds, because that was kind of the only game in town. State and local governments have gotten really creative over the past several decades, and they've developed all these new types of bonds that they're starting to use in place of a general obligation bond. Whereas it used to be the majority of issues were general obligation bonds, now less than 1/3 of the new bonds used by local governments are general obligation in nature. There are good things and bad things about general obligation bonds. First off, they are referred to as general obligation bonds because they pledge the full faith and credit of the government to repay the debt. What that means is the government says that we will use all the resources we have at our disposal in order to make the principal and interest payments on this money that we are borrowing. So by full faith and credit, they're saying, if we have to increase taxes, we will increase taxes to repay the debt. If we have to lay off employees, we will lay off employees. If we have to liquidate facilities and sell buildings, we'll sell buildings. We will do anything we need to do in order to repay that debt. The nice thing about that is that that type of unconditional guarantee of repayment means that it's a very safe investment for investors. They know that the government will do anything it needs to do to pay off the debt, so it's a very low risk type of investment. And you know, in investing, there's a relationship between risk and reward. The lower the risk, the lower the reward for those investors. The higher the risk, the higher the reward. So this is a very low risk investment, which means that investors don't expect to get a very high return on their investment. So the interest rates that governments have to pay on general obligation bonds tend to be the lowest of any type of bond out there. So they will save a lot of money because they have very low interest rates with this general obligation bond. But the downside is it is an unconditional guarantee of repayment. And so you are pledging every resource you have at your disposal in order to repay the debt. So it's low risk, but it's also low reward for those investors. We typically use general obligation bonds for buildings, our rec center and our city halls, for road construction and reconstruction, for jails and prisons, for school facilities. Those are the types of projects we tend to use a lot of these general obligation bonds for. But again, we use them much less frequently than we used to even 3 or 4 decades ago. Since we are using them less frequently, one of the main reasons, as I said, is because state and local governments have become very creative in coming up with other types of bonds that they can use instead of a general obligation bond. So another variation on a bond is what's called a revenue bond. With a revenue bond, there is no unconditional guarantee of repayment. So with a revenue bond, what the government is saying is that we pledge to repay this debt using the revenue that's being generated by the construction of this facility. So we're going to build a recreation center, and then we're going to charge dues and fees for citizens to use the recreation center facility. We're then going to collect those dues and those fees, and we're going to use those dues in order to repay the debt. So the debt service comes from the earnings generated by the facility. As such, they're riskier types of investments for investors. There's no longer that unconditional guarantee of repayment. So investors know that they may not get their money back, or at least they're less likely to get their money back than with a general obligation bond. So there's a higher risk. When there's a higher risk, they're going to demand a higher reward, which means that the interest rates on these debts on these bonds are going to be higher than what you saw with the general obligation bond. So revenue bonds tend to be more costly to local governments than general obligation bonds. But there is an advantage to a revenue bond. Not only are you not guaranteeing full faith and credit of your city to repay the debt, but revenue bonds are usually exempt from state-imposed limitations on bond issuance. Most states will have a cap that they place upon the amount of general obligation debt that a local government can issue. If you are bumping up against that cap, you've already issued all that you're allowed to issue in general obligation debt, a revenue bond is exempt from those state limitations. And so it's something you can do if you're running up against your limitation with general obligation bonds. A concern with revenue bonds is about their tax-exempt status. And this is important. Whenever governments issue bonds, they borrow this money. Their governmental bonds are competing against corporate bonds because private sector organizations also borrow money through the issuance of debt. Private debt usually pays investors a higher return than government debt. So the big advantage for government debt is it's usually a safer type of investment. But another advantage with government debt to help it compete against corporate debt is that the interest earned on government debt is typically exempt from income taxation. So that's something you can deduct from your federal income taxes, any interest that you are earning from government debt that you have purchased. General obligation debt has that tax exempt status. So whatever interest you're earning from that general obligation debt typically is going to be exempt from federal income taxes. However, that's not always true for revenue bonds. It depends upon the type of revenue bond. Some of these revenue bonds are tax exempt. Some of these revenue bonds are not tax exempt. If they are not tax exempt, obviously you're going to end up paying a higher interest rate to the investor because they've lost that advantage of being able to deduct the interest off of their federal income bill. The revenue bonds are just an alternative to your traditional general obligation bond. There are also what we call double barrel bonds. In a double barrel bond, they kind of combine the best of both worlds. So they combine the security of a general obligation bond with the lack of an unconditional guarantee that comes from a revenue bond. So the way in which it would work is a certain percentage of the issue would be general obligation in nature, a certain percentage would be revenue in nature. So you're constructing a recreation center, you know it's going to generate revenue, but you don't think the revenue is going to be sufficient to cover both debt service as well as the operating costs for that recreation center. So you secure part of the debt with the revenue that's being generated from the recreation center, and the remainder of the debt is secured with the unconditional guarantee of the full faith and credit repayment of the government with a general obligation type of an approach. So it's kind of a mixture of general obligation and revenue types of bonds. Investors may be more willing to purchase a double barrel bond than a revenue bond because it is safer, because it still has that general obligation component to it. In terms of interest rates are going to be lowest on general obligation bonds, highest on revenue bonds, and someplace in the middle with a double barrel bond. And we've been saying interest rates, but in the world of public finance, interest rates, when you're talking about bonds, are referred to as coupon rates. So whenever you talk bonds, the interest rate is actually called a coupon rate. And the reason why it's called a coupon rate dates back to the way in which people used to redeem the interest they were earning on these bonds. So typically back in the day when you would purchase a bond, you would get a coupon book. And then every month, whenever you were owed your interest, you would rip off a coupon, send the coupon into the government, and the government would then pay the interest that it owes you. That's why it's called a coupon rate. Obviously, we don't use coupon books anymore. Everything's done through EFT and wire transfers. And so we no longer have those coupon books, but we still refer to interest rates as coupon rates when we're talking about bonds. Another example of a different type of bond is a special tax bond. Special tax bond uses a specific type of tax revenue source in order to repay the debt. So you go back to your example of that assessment district that we created to put up streetlights in that neighborhood. We're going to use a specific increase in the property tax being paid by those people who live in that community, in that jurisdiction, in order to repay the streetlight project. Since you're using that to repay the streetlight project, it's going to have a weaker security and usually a lower bond rating than general obligation bonds and a higher interest rate because you no longer have the general obligation unconditional guarantee of repayment. We'll talk in a second about other types of bonds, like what are called zero coupon and capital appreciation bonds. There are lease revenue bonds. There are sale leaseback bonds. There are all kinds of different manifestations of bonds that state and local governments have created in order to try and get around some limitations. Local governments have created all these different bonds to get around state limitations. State governments have created special bonds in order to try and get around federal congressional limitations as well. But those are what we call bonds, okay? They're going to be, the long-term type of, you're going to be repaying it over a series of years. It's going to mature in anywhere from 2 to 40 years. Those are your long-term types of bonds that we use for a lot of our high price tag capital projects. Again, the only way that government bonds can compete against private sector bonds is if they have this tax-exempt status for interest earned on that debt. Historically, any bond that was issued by a government was considered to be tax-exempt, historically, because there was this principle known as reciprocal tax immunity. And I'll put that in text chat, reciprocal tax immunity. And reciprocal tax immunity was this constitutional principle that one level of government cannot tax another level of government. That one level of government taxing another level of government was essentially the same as allowing that government to destroy another government. There's a very famous case of McCulloch versus Maryland, where the state of Maryland had this state law that taxed all the fiscal notes issued by all banks within the state of Maryland. Problem was that the Congress had chartered this thing called the Bank of the United States, a national bank, and actually had just rechartered it as the Second Bank of the United States. The Second Bank of the United States was a national entity created by Congress, but it had what we consider today to be branch offices in a variety of different states. And it had a branch office in Baltimore, Maryland. Well, since that branch office was located in Baltimore, Maryland, Maryland had this law whereby they would tax all the notes issued by banks within the state. They started taxing the notes being issued by the Second Bank of the United States. So you essentially had the state of Maryland taxing the national government. Case went up to the Supreme Court in McCulloch versus Maryland. Marshall, writing for the majority of the court, said the power to tax is the power to destroy. And essentially creating this reciprocal tax immunity principle that one level of government may not tax the holdings of another level of government. That idea of reciprocal tax immunity was with us for 200 years. It started to be eroded, though, in the 20th century, and especially once we get into the 1980s, we see Congress taking some concrete steps to really start to erode reciprocal tax immunity and to allow it to have the opportunity and the ability to apply federal income taxation to interest earned on debt, even if that debt was issued by sovereign state and local governments. So in 1986, we had this big piece of legislation called the Tax Reform Act. If you remember, or if you've learned about the Tax Reform Act, you know that the primary goal of the Tax Reform Act was to reduce the number of tax brackets that we have and to reform our tax system to try and make it a little simpler and to make sure that people are paying less in taxes. That was the basic idea of the Tax Reform Act in the Reagan administration. But one part of the Tax Reform Act dealt with governmental debt and bonds. And what that part of the Tax Reform Act did is it created two different categories of governmental debt: public purpose debt and private activity debt. Public purpose debt would be something like a general obligation bond, where it's a city that's issuing it for a project that will be owned by the city, used by the city, a purely public type of project. That's considered public purpose debt. That remains tax exempt. So no changes to that in those types of general obligation bonds. However, Congress created a second category they call private activity debt. And they gave us a specific definition of private activity debt. You don't have to remember this. I'm not going to quiz you on this, but private activity debt was defined as more than 5% or $5 million of the proceeds from that debt are used for loans to non-governments, or if greater than 10% of the proceeds are used for non-government entities in business, and greater than 10% of the debt service is coming from payments from those non-governmental activities, then it's considered to be private activity debt. Well, so what? Why is it important? It's important because not all private activity debt will remain tax exempt. The Congress put caps and limitations on the ability of having tax exempt private activity debt. Those limitations were $50 per capita, so $50 per person in the population in that state, or a $150 million overall cap, whichever is greater. That's the limit of the amount of private activity debt that would remain tax exempt. So in essence, what it did is it pitted local governments against each other, and they had to compete against each other to get their private activity debt included within this cap to make that private activity debt exempt from the interest on exempt from taxation. When Congress did this, this is an erosion of reciprocal tax immunity. This is the federal government saying that there are certain things that are done by by state and local governments that we can't apply federal income taxes to. So it's no longer just this blanket sovereignty that you're a sovereign state or local government, so you're no longer subject to any type of federal taxation. Now it carves out some exceptions. Well, obviously, state and local officials were not happy with what happened in the Tax Reform Act. So they take their case to the court system. And the case makes it all the way up to the Supreme Court in a case in 1988 called South Carolina versus Baker. The Supreme Court in South Carolina versus Baker said that interest earned on state and local debt is not necessarily tax exempt. Basically saying that it's up to Congress. And they put the ball in the court of Congress. So Congress decides it wants to apply federal income taxes to all debt issued by state and local governments. It has the constitutional ability to decide to do that. Well, you can imagine what happened to state and local officials whenever this ruling came out. The sky was falling. It means that none of our debt will be tax exempt, which means we can't compete against corporate debt, which means state and local governments will never be able to issue debt ever again, and we'll never be able to fix our roads. We'll never be able to construct our buildings. We're never going to be able to pay for any capital projects. Well, that was a big overreaction. because Congress has made clear that even though it has the power to apply federal income taxes to interest earned on state and local debt, it didn't have the intention to do so. And so the federal government kind of stopped where it was in 1986 in the Tax Reform Act. If you're issuing general obligation debt and you're doing it for a purely public purpose, the interest on that debt is still considered to be exempt from federal income taxation. So a lot of the concerns of the skies falling among state and local officials was really kind of unfounded, and it really has not happened, at least up until this point in time. So one of the big advantages that governments have whenever they go out there and issue debt is the tax-exempt nature of interest earned on that debt. Another big advantage the government may have whenever they go out there to issue debt and borrow money. And whenever we say issuing debt, we mean they're borrowing money. Whenever they go out there, issue debt, and borrow money, another big advantage they can have is if they have a good credit or bond rating. The better your credit rating as a city, the lower the coupon rate you'll have to pay, and the less costly it will be to issue that type of debt. So it really behooves state and local governments to try and enhance their credit rating as much as possible. Kind of similar if you're going out there and buying a car or you're going out there and buying a house. The better your credit rating, the lower interest rates you'll have to pay. It's the same type of thing for governments. But governments have some devices that they can use in order to enhance their credit rating and save themselves some money. One of the things they can do is they can purchase what are called letters of credit. A letter of credit is when the government literally purchases the credit rating of a bank. Banks have very good credit ratings. That's where the money's at. So for the most part, banks have good credit ratings. You can purchase a letter of credit from the bank where you purchase the credit rating of the bank and use the credit rating of the bank in order to get a lower interest rate. The problem with that is that this is extremely expensive. Banks are sometimes unrealistic in how much they charge to use their credit rating. They'll oftentimes add points onto your coupon rate, which once you're done paying the points, you're probably pretty much where you will be at without purchasing the letter of credit. And the letter of credits are temporary, and that banks want to have you renew those letters of credit on a pretty frequent basis. As you might guess, every time the bank wants you to renew your letter of credit, it will charge you more money, and you'll have to pay even more in coupon rates. So letters of credit oftentimes are not a very good deal for state and local governments. So the second option for enhancing your credit rating as a government is to purchase bond insurance. This is probably the most common way to enhance your credit rating. So you'll purchase a bond insurance policy. And just like an insurance policy in our everyday lives, this insurance policy will have provisions that will pay out if the government is unable to make its principal and interest payments. So you're purchasing insurance to pay off the bond if something happens and you're not able to pay that bond off. So you've seen about a 22% increase in the use of bond insurance over the past several years. A third option, and what is probably the best option for a local government, the worst option for a state government, is a state credit guarantee. This is where states step in and they pledge to repay the debt if the local government is unable to do so. States don't like to do this anymore because they got burned by local governments. The state of California got burned by Orange County several years ago when they gave Orange County their state credit guarantee. The state of New York got burned by New York City back in the 70s and 80s when they defaulted on their debt, and the state of New York had to come in and make good on it. My home state of Ohio, Cleveland, defaulted on its debt, and the same thing happened with the state of Ohio. They had to come in and make good on those promises. So state credit guarantees are really, really hard to get these days. It's much more likely you're going to use bond insurance to enhance your credit rating to get a lower coupon rate. So we said the general obligation bonds, those are the typical ways in which local governments usually borrow money. But their popularity has decreased in recent years as we've seen the rise of more creative financing types of options. So here are some creative options that governments have used in order to borrow money. One creative option is the use of what are called serial bonds. Now, typically a traditional bond is going to be what we call a term bond. I'll put that in text. A term, T-E-R-M bond. So the traditional bond is a term bond. In a term bond, all of the issues within that bond all come to maturity at the same time. And this may sound a little strange, but whenever governments borrow money, when they issue bonds, bonds are issued in what are referred to as fives. And those are $5,000 denominations. And so there will be separate $5,000 issues, essentially, within an overall bond issue. In a term bond, all of those fives, all of those $5,000 denominations will all come to maturity at the same time. So they'll all mature in 20 years or 30 years or 40 years, whatever the case may be, however that bond is being structured. A creative option that most governments use today are what are called serial bonds. And this has really become the norm. A serial bond will have multiple maturity dates. And so different issues will come to maturity at different points in time. So perhaps you'll pay off one issue after 5 years, and then another issue after 6 years, and another issue after 7 years. The nice thing about having those multiple maturities in a serial bond is that once you pay off that one issue, that then frees up money you can spend on something else. So the more of those issues you pay off, the more money you have freed up for other types of expenditures that don't just have to go to debt service on this existing debt. State governments will put a limitation on the number of maturity dates in serial bonds. So you're not going to be able to have 100 different maturity dates. They usually limit it to no more than 5 different maturity dates within one single issue. But that's what's called a serial bond. That is the norm today in most debt issuance. Another creative option is what's called a zero coupon bond. Here in California, we refer to those usually as CABs, or capital appreciation bond. And in a capital appreciation bond, or a CAB, I'll put that in text chat, or a zero coupon bond, what happens is the government does not pay any interest during the life of the bond. All the interest that is owed to the investor is saved up, and then there's a balloon payment at the end, once it comes to maturity, where all the interest is paid all at once. Some investors like these zero coupon bonds, these capital appreciation bonds, because it's a built-in saving mechanism. So they want to save for a kid's college education, and they're afraid if they get their interest payments every single year, they're going to go out and blow that money. So it kind of forces them. They don't get it every year, so it forces them to kind of have a savings mechanism because they only get it in a balloon payment at the end. It also is beneficial for some governments because since they're not paying those interest payments through the life of the bond, they have money freed up for other types of expenditures and other types of projects. The problem, though, is if they don't plan ahead, once they get to the maturity date for that bond and that balloon payment is due, they may not have the money to make that balloon payment. They don't have the money to make the balloon payment. What they'll do is they will refinance it, borrow more money, and then use that newly borrowed money to make the balloon payment. And then you can kind of see it's a self-perpetuating cycle of debt that governments can get involved in. City of California has deemed it to be so dangerous that they don't allow a lot of local governments to use capital appreciation bonds anymore. School districts are no longer allowed to use a capital appreciation bond because so many districts got in trouble not being able to make that final balloon payment. Another provision is what's called a call provision, incorporating a call provision into the design of the bond. Call provisions are great for governments because they allow government to call the issue in and refinance it or refund it if the rates go down. So interest rates go down, you refinance it at those lower rates, you save the taxpayers a lot of money. Refinancing in the world of public bonds is known as refunding. So we don't call it refinancing, we call it refunding. And I served for a couple of years as a president of a JPA. And when I was in that capacity in that JPA, one of the things that we did is we refunded some existing debt that 2 of the school districts had. And the refunding ended up saving taxpayers $850,000 just by doing that refunding at lower interest rates. And so it can save taxpayers a whole lot of money. Now, you're only able to put those call provisions into the design of your bond if it's a very attractive bond to begin with. So if it's the type of bond that people are going to want to invest in, then you're going to be able to put those call provisions in. The opposite of a call provision is a put provision. A put provision that allows the investor to call the issue in if the interest rates go up and refund that issue to get themselves more money in interest payments. So it's just the opposite of a call provision. If you're having trouble selling your issue and the investors aren't falling all over themselves in order to purchase the issue, you may have to install a put provision to make that issue a little bit more attractive to those investors. So again, I mentioned before, there are a lot of other types of bonds like lease rental bonds and sale-back bonds and all kinds of other bonds we won't get into in this class that are creative ways to issue debt not using that unconditional guarantee of repayment like you would have with a general obligation bond. But those are long-term issues, those are bonds. Anything that's less than 1 year in duration and maturity is usually referred to as a note. So that's going to be less than 1 year in maturity. Different types of notes we typically see used are things like TANs, RANs, BANs, and GANs. As you can see on the screen, it sounds a lot like a Dr. Seuss book, but TANs, RANs, BANs, and GANs. They all are anticipation notes. So a TAN is a tax anticipation note, a RAN is a revenue anticipation note, a BAN is a bond anticipation note, and a GAN is a grant anticipation note. So the TAN, the tax anticipation note, you know you have tax revenue coming in the near future, but you need the money now. You borrow based upon the security of getting that tax revenue in the future. And you're anticipating it, so it's a tax anticipation note. RAN is just for general revenue. As I said, BAN is for bond revenue that you're anticipating, and GAN is for grant revenue that you're anticipating. A few years ago in the fiscal crisis, the state of California issued a lot of TANs and RANs in order to avoid running a deficit. So getting to the end of your fiscal year and your expenditures are exceeding your revenues, you're not allowed to do that. That's a deficit. The state constitution does not allow you to run a deficit. So to avoid the appearance of a deficit, you'll issue one of these anticipation notes in order to enhance your revenues, apply that to that previous fiscal year so you can avoid a deficit, and then pay off that debt once those revenues then come into the government. But those are very short, less than 1 year, oftentimes just maybe a month or two in duration, paid off very, very quickly. Now, the BAN anticipation note is something that you can use when you're shopping around for the best rate on a bond. You can get this bond anticipation note. It kind of ties you over so you can get the project started and then pay off that BAN with the bond proceeds when they do come in the future. When you issue a bond, those bond proceeds do not come in immediately. It's going to take a series of weeks before those bond proceeds actually come in. And so in those weeks, you want to get the project started, you can do a bond anticipation note. TECP, just really quickly, is called tax-exempt commercial paper. This is a very liquid asset. This is one of those examples of back when we talked last week about fiscal solvency indicators. We said, one of the ratios you can use is you can look at cash and cash equivalents. And we said, an example of cash equivalent is something that can be converted into cash very quickly. Tax-exempt commercial paper is something that can be converted very, very quickly. It has a very short maturity date, 15 to 45 days, oftentimes used to help you get started on a capital project as you wait for the permanent bond proceeds to arrive. And then a VRDO is a variable rate demand obligation, kind of similar to tax-exempt commercial paper, matures very, very quickly and has adjustable rates, which can be very dangerous today, especially with what's going on with interest rates. You get yourself in a whole lot of trouble if you have a lot of these variable rate demand obligations. But those are short-term issues. We usually refer to those as notes, less than 1 year maturity, whereas bonds are long-term. They mature in more than 1 year. I know we're running short on time, so very, very quickly, how do we go about issuing debt? What's the process for issuing debt? The first step in issuing debt is deciding whether or not you have the ability to issue that debt. As I said, that states will impose limits and caps on the amount of general obligation debt that local governments can issue. That's what's known as your general obligation debt capacity. So your first step in deciding what you can issue and how much you can issue is to calculate your debt margin. The debt margin is the assessed valuation of property within your jurisdiction multiplied times the percentage allowed under state law. So what most states will do is they will say you can only issue general obligation debt up to 3% of the assessed valuation of property within your jurisdiction. And that's a very typical debt margin that is imposed upon local governments by the state. So to know how much general obligation debt you can issue, you calculate that debt margin, your assessed valuation, usually times 3%. That debt margin, then you subtract from that any outstanding principal, general obligation debt principal you currently have, and the proposed principal that you are proposing to issue, and that will then tell you how much general obligation debt capacity you currently have. If you don't have enough general obligation debt capacity, then you're going to have to turn your attention to another type of debt, maybe a revenue bond or a special tax bond or something like that, if you don't have enough general obligation debt capacity to issue that GO debt. So you have to decide whether or not you have the legal ability to issue that debt. If you have the legal ability, you have the debt capacity to issue the debt, then you move on to the second step, which is issuance. You have to obtain the legal authority to issue that debt. So typically you're going to have a public hearing in the legislative body, whether it be a city council or a school district. There'll be a public hearing where you will discuss the amount of debt that you want to issue, and then you have public comments on that decision. If you are allowed to issue the debt and you go ahead and move ahead as a city council and you decide to issue the debt, then general obligation debt must go before the voters, and you must then seek and acquire voter approval. And this is a whole process that you have to go through. You have to put together ballot language that will specifically say how much the debt is for, how much extra this will cost taxpayers in terms of their tax rates, what the projects are specifically that will be funded by this bond measure. And you have to be very specific about what will be funded through this bond measure. You then have to seek voter approval. Typically for general obligation bonds, you have to get a 2/3 majority of voters in order to pass that general obligation bond. There are some exceptions to that. School districts can pass what's called a Proposition 39 bond, and a Proposition 39 bond only requires a 55% voter majority. But in order to be a Prop 39 bond and only have to get 55% voter majority, you then have to have a citizen oversight committee, and there are some limitations in terms of how you spend the money. The money may not be spent on any salaries or any benefits. It must be spent on only the projects that are listed in the ballot language that the legislative body has passed. So you have to get that legal authority. You have to get voter approval. The participants who are involved in this whole process, in addition to the legislative body, you will also then have a bond counsel. This is your bond attorney, essentially. This is your lawyer who's on retainer. And that bond counsel will then prepare what's called a clean issue. The bond counsel will make sure that you have the general obligation debt capacity, that you will follow all the steps you need in order to get voter approval and legislative authority to actually issue that debt. They will vet your ballot language to make sure that it is in compliance with government code. They clean the issue and make sure it's a legal issue. You have a financial advisor and underwriter. The financial advisor is the one that will help you design the issue, the payment period, whether it's a serial or a term issue. The underwriter is the individual who takes that out to market and will then take your issue out to the market to sell it to investors. If you're using a revenue bond, you have to have some bond security agreements. We won't get into these in depth, but suffice to say, if it's a revenue bond, the investor needs to make sure they're going to get their money back. And so they want you to have a certain amount of money in reserve to make sure that you have enough to make those payments. And typically it's 1 year of payments in reserve in order to make any payments in case you start falling behind in the revenue being generated by that facility. There are covenants that get built into your bonds, especially revenue bonds. The rate that you're going to charge in order to generate the revenue needed to make the debt service payments, professionalization of the operation of the facility that will be generating that revenue that will secure the debt payment, insurance, the amount of insurance and type of insurance you need to have, a default covenant, what happens if you default on the debt, how does the investor get their money back, audit governance, what types of audits you have to have done, and how frequently those audits have to be conducted. One of the major parts of issuing debt, though, is to obtain your bond rating. And there are three main bond rating agencies in America: Standard & Poor's, Moody's, and Fitch's. I don't have Fitch's on there because it's kind of the smaller one, but Standard & Poor's, Moody's, and Fitch's are three different bond rating companies. And what they will require that you do is you have to approach them to get a bond rating to see how credit worthy your bond issue actually is. So you apply to them, they'll assign you to an analyst, they'll require a ton of documentation, they will research your government and your fiscal trends, they will analyze the fiscal solvency of your government, they will make a recommendation to the rating committee, the rating committee will then assign a rating to your government bond that you are issuing. The better the bond rating, the lower the interest rate, the less money it will cost the government. And one of the trends that I have seen recently is that in the past, this was all done kind of remotely. Prior to COVID, they started requiring governments to come to them and actually come to their offices and make a presentation to their rating committees. And that's kind of unusual, but that's something that started just before COVID, kind of got shut down during COVID, but I think they're starting to return to that in recent months, where you actually have to go and kind of defend your life more or less in order to get your bond rating. Different companies have different bond ratings. You don't have to remember these, but the best bond rating you can get is a AAA. That's the best bond rating you can possibly get. That means you will have the lowest interest rate that you'll have to pay to repay that debt. Typically, if you're anywhere in the AA category, even down to AA minus, you're going to get a pretty decent rate. It's when you start to fall into the B category, triple B and double B plus, that's when your interest rates really start to go up. Anything below a BB minus with Standard & Poor's means that you're probably not going to be able to issue that debt because nobody's going to trust you to repay the debt. So you're not going to be able to borrow money. So it really behooves you to try and get the highest bond rating you can possibly get. And Standard & Poor's and Moody's, when they give you a bond rating, they're going to look at a lot of different aspects of your finances, to look at how you propose to use the debt, your plans to retire the debt, to pay off the debt, your current amount of debt burden, your debt history and trend, which is all in your statistical section of your annual comprehensive financial report. The current state of your capital plan, are you going to need to borrow a lot of money in the future to renovate your current facilities? Your promptness in bill paying, just like in our private lives, how prompt are you in paying your bills? Your tax base, the trends in your assessed valuation, your collection rate, and need to be at least 97% collection or above for property taxes in order to get a good credit rating. Your revenue portfolio diversity, are you have all your eggs in one basket with revenue, or are you diversified with a lot of different revenue sources? Your ratio of debt service, the amount you're paying currently to service your debt, divided by all the expenditures that you are making. The accuracy of your estimates and your forecast. Last week we talked about revenue forecasting and expenditure estimation. How accurate are those estimates and those forecasts? Your level of professionalization in your government, your level of service provision, and how satisfied are your citizens with their current level of service provision. How reliant are you on intergovernmental aid? Again, that's one of those fiscal solvency indicators we talked about last week. The percentage of intergovernmental revenue divided by your overall revenue. How reliant are you on intergovernmental aid? If you're very reliant on intergovernmental aid, obviously that's not a good sign for a bond rating. Your land use. How developed is your community? Do you have a lot of room for additional development, or are you 100% developed? If you're an older community, you're 100% developed. It means that the only way you're going to enhance your property tax base is through redevelopment. If you've got a lot of, like the city I live in, it's about 60% developed, so 40% is still undeveloped. There's a lot of room for growth in that tax base. Population and wealth trends. Again, from that statistical section of your annual comprehensive financial financial report, what's going on with your population, people moving in, people moving out, what's going on in terms of the wealth of those individuals who are moving in or moving out of your jurisdiction. And your commercial and your industrial base. Is that going up? Is that going down? What's that thing going to mean for the amount of property tax revenue you're going to be able to generate from your industrial and your commercial base. Just kind of give you a flavor of some of the types of things that these agencies are going to look at to assign a bond rating. It's also important to note that when they assign a bond rating, you can get a different rating for different types of issues. So it's not just one rating for the city. It's a rating for each of the different issues. So your bond rating with a general obligation bond may be a much better rating than if you had a lease revenue bond or if you had a special tax bond. So these are bond ratings that are for each individual bond, not just the city as a whole. And then finally, once you have your bond rating, then you have to go out to market and you have to sell the security. And this is typically done by your underwriters. So there are two ways that you can sell it to an underwriter. You can either sell it through a competitive bidding process or through a negotiated bidding process. In a competitive bidding process, you put out an advertisement and you invite underwriters to bid to buy your issue. In a negotiated process, you select an underwriter and then you negotiate the best price with that underwriter. In my experience, most governments use a negotiated bidding process because it'll save you a lot of money and you're able to negotiate the price with underwriters. There is a standard underwriter fee, which is extremely expensive. For our $148 million bond issue, the underwriter fee that was statutorily required was $750,000. So the underwriter got $750,000 to go out there and sell this $448 million issue to the public. And most of the people who end up purchasing this debt for state and local debt, they tend to be what we call the mom and pops, in that they are individual investors looking for a very secure type of investment for their retirement. And so those are the folks who tend to buy a lot of this state and local debt. So that's kind of our tour de force with debt management. Again, the whole purpose of issuing debt in this perspective is to fund these capital projects because they're such high price tag projects and they are also long lifespan, which means that there's this theory known as intergenerational equity. And intergenerational equity will argue for the issuance of debt, that if you're going to construct this recreation center, and this recreation center is going to be around for 60 years with the proper maintenance, is it really fair to have only the people who live in the city in year one pay the entire cost of this recreation center that will be used for people for generations to come? Or should we not spread the burden of paying for this recreation center across everyone who will be using it, even including future generations? When you issue debt, like a 40-year bond, you are spreading the pain of paying for the recreation center across 40 years. And so across future generations who will be using that recreation center. And so that's what we know as intergenerational equity. You're spreading out the costs for everyone who will be using that recreation center in future years. And so that's oftentimes why we issue debt, in order to pay for these types of capital projects. Now that's issuing debt. There is a difference between debt and deficits. And we'll close on this idea tonight because it's a very important idea. There's a difference between debt and deficits. A deficit is an imbalance between revenues and expenditures in one given fiscal year. And as we talked about when we discussed the federal budgeting process, we said that the federal government has run an annual budget deficit every single year since 1969, with the exception of 2 years. So the federal government runs a lot of these deficits every single year, and very large deficits. But that's an imbalance in one fiscal year between revenues and expenditures. State governments are usually precluded by their state constitution from running those types of deficits. They have to balance their revenues and expenditures. Debt is different. Debt is longer term in nature. Now, granted, if you're running deficits each and every year, the accumulation of those annual deficits will then contribute to your overall long-term debt. But some of that long-term debt's not coming from deficits. A lot of that long-term debt's going to come from funding these needed capital projects. So there's good debt and there's bad debts. Good debt is debt that you incur from funding these needed projects that will benefit your community. Bad debt would be the accumulation of the deficits, because you can't balance your books every year. Those accumulated into debt, that's bad debt. So there's good debt and there's bad debt. So not all debt is created equal. And I know we're past 6:30 and we've been going for a very long time tonight. So there's a lot more we can talk about with debt. Like a lot of the topics in this class, you could teach an entire semester-long class on state and local debt. We just don't have a class like this in the program. But this kind of just gives you the flavor of how governments borrow money in order to pay for these long-term high price tag capital projects. Any general questions about what we have covered with debt and debt management? Okay. If not, then again, as a reminder, you'll be doing beach board essay number 3, and that's going to be due next week, where you'll be looking at your annual comprehensive financial report and assessing the fiscal solvency of your city. So you got that coming up due next week. Then in class next week, we will start talking about revenue and tax revenue generation. We will talk about the evaluative criteria of taxation, and then we'll apply that evaluative criteria in our analysis of the major forms of taxation. So we'll spend time talking about property taxes, we'll talk about income taxes, and we'll talk about consumption-based or sales taxes, their advantages, their disadvantages, and how each of those forms of taxation work. And that's where we'll target most of our attention for next week. I'll have this recording up and available on our beach board site no later than tomorrow morning, that you can go back and review if necessary. And then we'll be back at it again next Tuesday. Okay? All right. Thank you for being here tonight. Have a good week, and I will talk to you again then next Tuesday. Take care.
Thank you.
Thank you. Have a good night.
Thanks.
Thank you.
Thanks, everyone.